Welcome to this explainer. You know, if you've ever stared at a stock chart and felt like, well, you're looking at pure, unpredictable chaos, trust me, you are not alone. Today we're building a definitive visual study guide to really decode the financial markets. We'll be diving deep into the Wyckoff methodology, drawing on the incredible work of Ruben Villahermosa Chavez. This explainer is all about helping you see the hidden, highly logical structure right beneath all those kind of terrifying price fluctuations. We're going to take these abstract economic theories and turn them into tangible tools you can actually see right there on your charts.
Okay, let's dive into this. To the untrained eye, price action is just noise. Random, terrifying spikes and drops that seem completely disconnected from reality, right? But the professionals? Oh, they don't see chaos. They see footprints. The central problem we all face as traders or investors is just making sense of that movement. But here's the secret. Behind every major price move, there's a highly structured, super logical foundation dictated by the constant back and forth between buyers and sellers. Our whole goal today is to learn exactly how to read those footprints.
So here's our roadmap for this visual analysis. First, the absolute bedrock, the three fundamental laws. Next up, we'll see how those laws create the continuous phases of the price cycle. And finally, we'll jump from theory right into practice with real examples in action.
All right, let's get right into section 1, the three fundamental laws. These are the underlying rules of the game.
So the Wyckoff methodology really rests on three main pillars: the law of supply and demand, the law of cause and effect, and the law of effort and result. Listen, these aren't just arbitrary trading tips, okay? They are the fundamental laws of physics and economics that drive literally every single price movement in a free market. Grasping how these three interact, it gives you a massive objective advantage. You stop guessing and you start observing what the market is actually doing based on mechanics. Once you get these pillars down, you stop reacting on emotion and start trading on pure logic. Let's break them down. First up, the law of supply and demand. I know it sounds like basic economics 101, right? But its application here is actually profound. If buyers are more aggressive than sellers, demand exceeds supply, and the price absolutely has to go up, period. If sellers are more aggressive, supply takes over, and the price falls. But, and here's the kicker, what happens when they match? Well, if they're in perfect balance, the price moves sideways. And, as we'll see in a minute, that sideways movement is where the real secrets are hiding. Just remember, whether an order comes from a retail trader in their living room or massive institution's algorithm, every single order adds liquidity and tips this critical scale.
Next, we've got the law of cause and effect. The core idea here is that a massive market-shifting trend, it doesn't just materialize out of thin air, no way. To see a big change in price, which is the effect, a root cause has to be built first. Think of these sideways lateral phases as an oven. You can't get a cake without baking the batter first, right? Well, the sideways phases on a chart are that oven. That is exactly where the next big market move is quietly baking. Professionals actually use this extended time to discreetly accumulate or distribute massive amounts of assets long before the trend officially kicks off and the rest of the world finally catches on. And this brilliantly illustrates our third rule, the law of effort and result. In the financial markets, effort is trading volume, the sheer amount of energy and money changing hands. The result is the price action, how far the price actually traveled. Naturally, without the effort of volume, a true, sustainable result in price just can't happen. We're constantly scanning for harmony or divergence between these two things. And here is the absolutely crucial part. If we see a massive spike in trading volume, a huge effort, but the price barely even budges, that divergence is a massive red flag. It's telling us big players are quietly absorbing all that momentum, signaling a major shift in control.
Moving right along, let's head into section 2, phases of the price cycle. This is where we watch those foundational laws play out sequentially over time.
The market is definitely not a straight line. It's an endless loop stepping through four main stages. It kicks off with step 1, accumulation. This is where the strong hands, we're talking massive institutions, the smart money, quietly buy up assets at a massive discount. That builds the cause for step 2, the uptrend. Then, once prices are pushed high enough, we hit step 3. Distribution. This is where those same pros sell off their massive holdings to less informed buyers. That big sell-off builds the cause for step 4, the downtrend, which eventually crashes right back down into a brand new phase of accumulation. Knowing exactly which phase you're in, that's your ultimate defense against trading against the primary trend.
Now, what's really interesting about this slide is how we put a magnifying glass on those sideways accumulation or distribution zones. When you map this out, it completely changes how you view a chart.
The Wyckoff methodology breaks these critical trading ranges into 5 really precise microphases. Look closely at phase A. This is the exact moment the previous trend is stopped dead in its tracks. The momentum just breaks. Then we slide into phase B. This is where the real cause is built, as buyers and sellers fight this drawn-out, exhausting battle for control. The baking process is in full swing here. Next up is phase C, which is absolutely critical. It usually features a definitive test, or kind of like a fake-out, deliberately designed to trigger stop losses and trap amateur traders who jump the gun. Once that test is done, phase D begins the new trend inside the range, ultimately leading to phase E, the definitive breakout. That's when the new trend is officially confirmed and leaves the range entirely.
All right, we've covered the theory and the structure. Let's transition from theory into practice with Section 3, real examples in action.
Let's move to and see how this builds on a macro level. Notice the top blue box on this Euro to US dollar weekly chart. That massive structure is the cause. Literally months of distribution where the supply of the asset quietly overwhelmed demand. Institutions were unloading. And the effect? That aggressive, steep downtrend that immediately followed. It's undeniable once you zoom out. And then, once the price finally bottomed out after that fall, it entered the lower blue box. Down here, a brand new cause of accumulation was painstakingly built over many weeks, which eventually resulted in the effect of a new, sustained uptrend. It's the law of cause and effect visualized perfectly on a really grand scale.
Now let's zoom in from micro view. We're looking at a 2-hour chart for the Spanish textile company Inditex. This right here is a textbook classic distribution structure. Notice how phase A kicks off with a buying climax. Look at that massive spike in volume on the bottom indicator. That huge burst of effort stops the previous uptrend right in its tracks. Immediately after, we get an automatic reaction, pulling the price down and creating a clear change of character in the market's behavior. As we chop through the messy range of phase B and C, the strong hands are methodically offloading their massive positions into any remaining buying pressure. By the time we hit the end of phase D, the whole dynamic is shifted. We see a major sign of weakness, aggressively breaking the support level, dropping the asset right into phase E. And boom, the new downtrend is officially underway.
So, the crucial point is really captured in this singular idea from Ruben Villahermosa Chavez. A trend will end and a cause will begin. A cause will end and a trend will begin. The market is not just some random walk. It's a continuous, highly logical cycle of building tension in lateral ranges and then violently releasing that tension in clear directional trends. Your job, as an informed participant, is to interpret these conditions using the raw data of price and volume.
The Wyckoff methodology really empowers you to stop reacting blindly to those terrifying price drops and euphoric spikes, and instead start looking for the underlying structure. So here's a challenge for you. Open up your own charts right now, whatever market you trade or follow. Apply the laws of supply and demand, cause and effect, and effort and result. What lateral phases are forming? And most importantly, what is currently baking in your portfolio? Thanks for joining this explainer, and remember, always look for the footprints.